Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at two shoe companies today, Decker Outdoors and On Running. Decker produces the Hoka shoe, On Running has the On shoe. These companies have done a good job of taking market share from companies like Nike, which is why Nike is down about 8.3% in the past 5 years. If you compare that to a stock like On Running, this company is doing pretty well in the last couple of years, up about 18% since its IPO. Not a huge performer, but if you look at the last year, up 53% as the stock market started to realize the value of a company like this one. Then you look at a company like Decker Outdoors, up 33% year to date, up over 71% in the past year, even though it was down almost 7% yesterday as the market kind of chilled off a little bit. We'll look at these companies and see what their valuation looks like. But essentially, what's happening here is these two companies are growing really quickly, while some of the larger, more mainstream players are starting to lose a little bit of market share to some of these other guys. The question is always going to be, are the valuations of these companies a bit over where they should be because of that growth, and will they slow down? Again, Decker's trading at a multiple of 4.4x to sales versus 2.5x for Nike, versus 1.8x for Adidas. Then On Holding trading even higher at a 4.7x sales multiple. However, when you look at PE multiples, when you look at free cash flow multiples, at least Decker's is kind of in line with Nike, only trading at a multiple that's 2x higher on both the PE side and the free cash flow side, whereas On Holding, which is growing at, again, double the rate of a company like Decker's, is trading at a much higher multiple. The thing that always worries me about companies like these, companies that are growing really quickly, is you can look at a company like Under Armour, for example, and how they did in the early 2010s. You look at those estimates and you sort of see something that is going to hearken to what we're going to look at in a second. You've got a company that's basically growing in the low 20s to mid 30s for years and years and years and years until it doesn't really quickly. And that can happen quite quickly as the brand matures, as the brand gets less popular, as the quality drops off. You're kind of seeing some of that with a company like Lululemon right now. Again, this is apparel versus shoes, and I think shoes are a better business in general, but you can see that Under Armour was rewarded very quickly during that growth pattern, and as it started to slow, the stock is basically back to where it was 18 and a half years ago. Not a good return long term, but if you can time it correctly, this could be a really solid return in the short term if you think about it that way. But if you're looking from a long-term perspective, like I often am, it worries me a bit that stuff like this can happen where the returns can be really good for a really short period of time as growth is amazing, and then growth can really drop off a cliff pretty quickly. So as we look at the shoes, On Running makes, kind of simplistic, solid, well-engineered shoes. I actually wear On shoes myself. I switched from Adidas completely maybe 2 years ago, and I've worn nothing but these since then. They're not cheap, $140 per shoe, and this is for this model. They certainly get more expensive. This is kind of one of their simpler models. A variety of colors, kind of a cool look. I like the look. It's minimalistic. It's nice. It's nothing amazing, but it's cool, and it's Swiss engineered. And the shoes are just comfortable. Then you've got Hoka, which are made by Decker Outdoors. These are more maximalist shoes, a lot of padding. You can kind of see the massive amount of padding here. What got me interested into this brand and these shoes in general is that my wife went to a podiatrist who himself was wearing Hoka shoes. He recommended those shoes for some pain she was having. She's gotten two pairs since then. Again, not cheap, $160, rarely go on sale. That's kind of the thing with these brands. They can maintain high margins because they are a unique shoe brand. They are growing quickly. They're still new. They're still hip, and they're selling shoes at full price, and they can maintain decent margins. And that's why the multiple of a company like Deckers can be higher on this revenue side than Nike, but their free cash flow multiples can be relatively similar because Deckers has 15 to 16% free cash flow margins, whereas Nike is at 10% because their shoes are always selling at full price. And they're hard to find, and they're unique, and they do a lot of solid business. And essentially, what they've done on the wholesale side is really solid. They only partner with certain wholesalers. You can go to Dick's and find these shoes. You can go to REI and find these shoes. You can go to stores like Fleet Feet, specialty running stores, etc. But they're not everywhere. I do think they have them at Foot Locker. I haven't been there, but they really make sure that these partners put their shoes out front. So when I went to Dick's, there's Hoka. It's right there. I see it. Big display for Hoka, big display for On Running. Nike was still there, Adidas was still there, but these guys are certainly getting a lot of premium shelf space. And that's kind of Nike's fault that it allowed them to do that, because Nike concentrated more on the direct consumer strategy, gave up a little bit of the wholesale ground to companies like On Running, like Hoka, and these guys took full advantage of that and grew really quickly, and that really hurt Nike in the long run, because the strategy is always going to be go into the wholesale space, make sure you have good partners in the wholesale space, because people are going to go to those stores, try on those shoes, and once they get your shoes, they can buy those online, and you'll make money. You'll make more money online, higher margins online, but wholesale still matters a lot because it gets those customers in through the door. And once they're in the door, there's a relative stickiness to shoes. People don't often change shoes. When they do, they probably stick with those for quite some time as well. I was an Adidas guy for, the last 10 to 15 years at least, and now I'm an On guy for quite some time. Maybe I'll try on some Hokas to see how they feel. My wife seems to love them, but I'm probably going to be an On guy for quite some time. And that's the case with a lot of shoes. When you buy a pair of shoes that you really like, you tend to stick with them, and you are willing to pay an excessive price to get them if you're, doing relatively well. I think when you look at On shoes, when you look at Hoka shoes, they're still kind of a higher level shoe. Whenever you're paying 150 plus for a pair of shoes every couple of months, you're probably pretty well off. So they're targeting a higher end customer. The low end customer is kind of struggling right now, as evidenced by earnings like the Dollar General earnings, but the high end customer still doing relatively well. So these stocks haven't been impacted. However, if there is a bit of a slowdown, a bit of a recession, stocks like this will certainly be punished because the valuation here is pretty hefty. So you're buying these at a pretty hefty valuation for the growth ahead and the margins that they're giving you. So again, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. As we look at the valuation here, I do like the shoe business. Again, it is a repeat business. It can be a high margin business, as evidenced by Deckers. So if you're a runner and you are a Hoka fan, you're probably replacing your shoes every 2 to 3 months. So you've got this repeat customer that's paying $160 every couple of months, and they're going to continue to do that for potentially years and years and years and decades ahead. And that is a pretty solid business if you can get into it at a decent price point. What has Deckers done? Well, they're a brand aggregator, kind of. They have two main brands. There's Hoka and there's UGG. Those are the brands that generate 99% of their revenue. They have a couple of other smaller brands. I think there's Teva. I think Sanuk they just recently sold off, and maybe there's one other brand, but that's really it. They could certainly buy another brand, but in the meantime, you're sort of assuming that this is going to be their brand cachet. It's like, hey, we've got UGG, which is growing at a decent clip, those UGG boots, and then we've got Hoka, which is growing at a really good clip, 30% or so in the last quarter. Buybacks here have been the story. They do generate free cash flow, have been doing it for quite some time. They've been buying back shares. They've gone from 32 million shares in 2016 down to 25 million or so in 2024. That's going to continue to be the case. That's kind of the story here. You're getting growth, you're getting shareholder return via buybacks, and that is the thesis. So you've got two brands of shoes that are growing, that are going to continue to grow. You've got margins that are really solid for the shoe space. Mid-teens are a lot better than Nike, a lot better than Adidas. If they can hold on to this and continue to grow in the high single digits, low teens for the next couple of years, this is a solid company. The question is, does the valuation make sense for a company that's probably slowing? You're paying a 3.1% free cash flow yield, or you're getting a 3.1% free cash flow yield on the next 12-month basis based on these assumptions, based on this valuation. Kind of expensive. When I look at this based on these assumptions, I kind of would want this to be valued in the 3.5% range. So if I put a 3.5% valuation for their future market cap, gets me to an expected return based on these assumptions of about 7.4%. Again, these assumptions are here. 50% of their money going towards buybacks. You can play around with these numbers as you want. I'll leave a link to this file down below. Just hit file, make a copy. And with all of these assumptions in mind, with this scenario of a 3.5% future free cash flow yield, I get a fair value at a 10% target return of about $803, about 10% lower than it is today. If you're a bit more aggressive, you feel like that a 3% free cash flow yield makes more sense. The fair value is right around where it's trading at today of about $900. If you're a bit more conservative, you feel like it should be closer to 4%, you get a fair value of about $700, or about 22% lower than it's trading at today. So that's kind of where I sit. Is this a good value at $900? I don't think so, but if it keeps falling a little bit, if it gets into that $800 range, maybe I'd get interested. One thing to keep in mind with these stocks is that, yes, there's a bit of a correction yesterday. It's down 7% yesterday. It's down maybe 10 to 15% since their highs in May, but this stock traded at $524 just a year ago. there could be a little bit of a correction. The market could correct. It doesn't mean that because you like a company, you have to dive right into it and buy it at any price. Maybe it'll run away from you. Maybe the momentum here will pick up and this thing will be 1,500 in 2 years and you'll be like, crap, I should have bought it. But for me, I'm a conservative investor. I like to wait for valuations to get to where I want them to be. For me, this would be in that $800 range. If it doesn't hit that, not a huge deal. This is a company I would like to own, but when I look at this from a 5 to 10 year perspective, I always worry that these companies get overvalued in the short term and the market corrects really quickly when that valuation needs to correct. So when this starts to slow, when this is a 4 to 5% a year business in a couple of years, what does that mean for a company like Deckers? I looked at Adidas. Adidas has a $45 billion market cap, and this is a $22 billion market cap with revenues that are a fifth of what Adidas has, with cash flows that are lower than what Adidas has. So when I look at Adidas, is this the future of a company like this? Adidas is a $45 billion market cap. Nike is a $125 billion market cap. Where is Deckers going to be? Nike is a 10x revenue from Deckers right now. It has lower margins, but is $125 billion market cap reasonable for a company like Deckers? Can they take market share in such a way that 10 to 15 years from now they're going to be a $20 to $30 billion revenue business? That's kind of what you're hoping for if you're investing in Deckers. I think potentially, Hoka certainly has, at least right now, the brand cachet to grow at a decent clip for years and years to come. But that can change really quickly. That's the risk you're taking when you're investing in a brand in a company like Deckers, right? It could drop off just as quickly and the valuation could correct really quickly. So when I look at this and I look at a 3% valuation, it's not super crazy, but it is a bit rich, and I would like it to be a bit cheaper because there's a risk inherent with investing in brands. You see it in Nike not returning anything for 5 years. You see it in Adidas not returning anything in 5 years. Could Deckers be similar 5 to 10 years from now? Potentially. That's kind of the risk you're taking. So if I were to take that risk, I'd need a bit of a better return profile than the one I'm seeing here. Yes, you can make an assumption that the free cash flow yield is going to be richer, but that's a risky bet to take. Then we look at On Holding. Again, a newer company, just IPO'd in 2021, raised a bunch of money, so their balance sheet is also pretty solid. Hasn't been doing any buybacks or anything, so just some stock-based compensation, increasing share count since 2021, growing at a really rapid clip. And the expectations here are that this is going to continue for the foreseeable future, and this is a risky expectation. You're sort of saying that this thing is going to grow 20% year over year over year over year over year, and it's not going to stop. And that's where the basis of this valuation comes from. So if there's a little bit of a hiccup, a little bit of a miss, a little bit of a slowdown, this thing can correct really, really quickly. This thing is valued even more richly than Deckers. A bit more risk here, but also potentially a bit more upside as well, because the growth here is really impressive. The shoes here are really impressive. The margins are already at 10%. I'm assuming that they're going to grow to about 11% by 2028, but there's more upside from here, I think. The estimates here don't assume a lot of margin expansion, but if you look at Deckers, similar price point shoes, maybe slightly more expensive. Maybe with Uggs, they have a bit more margin there as well, whereas this is just one brand of sneakers, so the margins will be compressed a little bit. But if they can reach 12%, 13%, certainly not unreasonable if you want to play around with the numbers. I do expect some sort of buyback in the near term, only 25% here. You can certainly make this higher at 50% because what else are they going to do with their money? From a valuation perspective, because it's still growing in the mid-teens by 2028, I'm assuming 2.5% for a free cash flow yield. With that in mind, I still get about a 7.5%, 7.2% expected return. If I'm targeting 10%, I get a fair value of about $40. And this is aggressive, I think. This is aggressive assumptions. I feel less comfortable about this than I do about Deckers. Essentially what I'm saying here is that by 2028, this brand is going to have $4.7 billion in revenue, similar to what Deckers has today. Today, Deckers is a $22 billion market cap company. Because Deckers has better margins than what I'm showing here, $700 million in free cash flow versus $500 billion. This is a slightly lower market cap, but you can kind of see the reasonability check making sense here. Deckers is currently trading at a $22 billion market cap. This is going to be a company that's a similar size as Deckers in 2028. It's going to be trading at a 20 billion-ish market cap. So you can kind of see that the returns seem to make sense, but this is an aggressive assumption in my mind. However, if you kind of flip the switch and get more aggressive, you say, well, Deckers has 50% margins. Why can't this have 13% margins? Then your expected returns get closer to 8 to 10%. Now your fair value is closer to where it's trading at today. I think that's what investors are betting on when they invest in a company like On. But again, you look at On and you say, well, is this going to drop 10%, 12%? Well, what if the fair value here in 2028 is a 3% yield? Well, sorry, a 3% yield. Well, my friend, then it's closer to a $33 fair value. That's sort of where I'd be if I wanted to be conservative. If this brand dropped into the low 30s again, I'd probably get interested. But for me, this seems like the assumptions have to be really aggressive for the valuation at today's price point to really make sense. You basically have to go to a 2% yield with these growth assumptions, with this margin expansion, with this stock buyback to really make sense of where the stock is trading at today. So for me, I think Deckers is a more interesting prospect at today's prices. And again, you say, well, why should this drop 20%? Well, it's up 53% in the past year. A little correction wouldn't hurt anybody. I mean, this thing was trading at 37 bucks just a month or two ago, was trading at 31 bucks a couple of months ago. If the market corrects, which it certainly could because it's been on such a tear in the last couple of years, a lot of these stocks could come down into reasonable ranges. And for me, for Deckers, that would probably be in the sub 800 range. For On, that would probably be in the low 30s range. And until then, I'm not really interested because the upside is here, I think, because these are really good brands that can continue to take market share and grow in a really big global market. But the downside is potentially very severe. And I don't necessarily need to have a lot of exposure to consumer brands like this one. You know, I just would need them there to be a really interesting valuation. And they're just not there right now. But these are both brands that I really love. I would like to own them because of the fact that I like the brands. I think they're going places. They're going to continue to take market share. But I just don't see that the valuation is all that intriguing right now. So what do you think? Do you disagree with me? Do you think these brands are amazing? Do you hate them for whatever reason? Or do you think that they're going to continue taking market share like I do? Do you like the valuation here, or would you want more? For example, if you want a 15% target return from Deckers, it's a $650 price point. You know, not unheard of. Would be really interested in that for me. If you look at a On return at a 3% yield with a 15% target return, get a $27 price point. I think both of those would be really intriguing entry points for me. But what do you think for yourself? Are you a shareholder? Are you a buyer? Are you a seller? Let me know down below. Like, subscribe, all that good stuff. Thanks for watching. Bye.